it's to react to short-term rise in trade would be an overreaction. So positioning portfolios for a U.S. recession or a long-term trade war in the face of what's going to be very easy monetary policy is not a winning investment formula. So investors still have little choice but to remain invested in cyclical stocks with good growth characteristics from that standpoint.
Okay, are you paring down your fixed income exposure at all, given how incredibly low global bond yields are?
No, I think one interesting idea here for investors is U.S. real estate investment trust, REITs. And the reason why I say that, Kelly, is that about 88% of their revenue comes domestically. So they're insulated a little bit from the U.S.-China trade kind of rise in tensions from that perspective. The other thing, as we know, they yield around 3.5%, so much greater than traditional long-term fixed income right now. And both revenue growth and earnings growth are higher than the market right now. So all three of those characteristics favor kind of an allocation to U.S. REITs, in my opinion.
Yeah, that 3.5% yield is 50% higher than what the 30-year bond gives you right now. David, what about you? Are you guys concerned about a recession? Michael says he's not.
Well, we're concerned about volatility. A recession is another story, but we don't need a recession to see higher volatility. What we're really concerned about is earnings growth. Earnings growth continues to be weak. Continued uncertainty about the trade war has already impacted corporate spending. It will soon impact consumer spending. If unemployment levels start to rise, and if we start to see significant cuts in 2020 earnings estimates, we're going to really start to be worried.
So, Bruce, let me turn to you and get your thoughts on what happened yesterday with the Chinese currency and whether we in the media and others overstated it. We were very quick to call this potentially the first shot in a currency war. Do you see it that way, or was this just a very pointed message sent in the U.S.'s direction?
Well, I think there's two things here. First of all, the dollar was going up broadly, and each time we've had a tariff announcement, the dollar has gone up and the yuan has actually gone down. So there's part of this which is just normal response. But I don't think that's all. I think with the Chinese willingness to break through 7, I think with the response of the U.S. administration, I think we are seeing a deterioration. So I think it is a signal by the Chinese. It is a signal, and more broadly in terms of what we're seeing, that trade conflict is intensifying, and there are a lot more risks around what might happen next as a result of that.
Is it also a message that Xi is willing to use his currency as a weapon?
I don't think that's preferred. I think it's a signal that there is that as a possibility, and I think there will be less willingness to keep it stable. Remember, they've been keeping it stronger as negotiations have gone on here. I don't think it's their preferred device to have the currency go down sharply here.
So let me get your reaction to labeling China as a currency manipulator, and how come we wouldn't have labeled them a currency manipulator when they were fighting to keep the renminbi higher?
Well, I think in the current environment, for them to be called a manipulator is probably incorrect. They're not trying to weaken their currency. They're not actively moving in one direction in the market. I think in the past, in the long past, there were circumstances where that was appropriate. I think the action the U.S. took here was symbolic, but it's important in its symbolism that the U.S. is getting more aggressive and could move on broader fronts here.